Perfect. Good morning and welcome to another episode of PLA. It's myself and Bruno today, and we'll be handling it going forward. Morning, Bruno. How are you?
Hey Nick, how are you doing?
Well, thank you. Perfect. So let's get straight into the questions. Bruno, I've got one for you to start off with. So we've had a client who's come in and they're asking about capital gains. Specifically, this client is interested in doing flips of properties. And so the question really relates to why capital gains is at a higher rate for companies, okay, over individuals. And so really they're looking at structuring if they want to do property flips. What kind of structure do they do it in, and what is the tax benefit that they can get out of doing different structures?
Well, thanks, Nick. So the implications of capital gains of property transactions are quite important because you often find that there are gains that need to be taxed. So one first needs to understand the difference between your normal tax and your capital gains tax and how these impact properties. One of the biggest mistakes people make, and I hear a lot of advisors out there trying to advise that you can flip properties and you only need to pay capital gains to SARS. That's not actually the fact. It comes down to the intention of the taxpayer. If a taxpayer buys the property with the intention of flipping the property, all they're really doing is buying stock and trade. And if you buy stock at a cost price and you sell it at a higher price, you get taxed on that margin. It's exactly the same with property. So capital gains is paid in property transactions when you intended buying the property as a capital asset, retaining the property as an investment, and getting income from it. Now, that's and there's a whole bunch of examples on how this can play out. But the most typical example is to say if the property is bought without the intention of reselling for a profit. That's one of the easiest ways of considering this. But there are circumstances, for example, where a person buys a property and for some reason, sheer luck, an offer is made on that property very soon after they purchased it, and they sell it, and they realize it at a decent price. That doesn't mean that now all of a sudden it's the income is revenue in nature. All that really means, though, is that you are able to realize that asset in the best possible way. So you could still pay capital gains in that transaction as opposed to normal tax. So now let's take it one step further, just to try and differentiate or understand what capital gains is versus normal tax, and especially the calculations around it. Because the way that I opened the answer was to make it sound like one would actually want to pay capital gains. One structures transactions so that capital gains tax is payable versus normal tax. But why is that? And there's often a confusion on the calculation of capital gains tax, simply because it works slightly differently to the way that normal tax is levied. Now, remember, capital gains tax is it's basically the gain between what your base cost was, which is often your purchase price, just for the sake of simplicity. So let's say, for example, you bought the property for 100 Rand, you sell it for 200 Rand. That difference of 100 Rand, that would be your capital gain. Now, if you're flipping a property and you buy the property for 100, you flip it for 200, your profit is 100. You get taxed on that 100. Whatever your tax rate is, you get taxed on that 100 Rand. So, for example, if you're a normal individual taxpayer, and let's say you're at the highest marginal tax rate of 45%, you pay 45%. So out of that profit of 100, you pay 45 Rand. Normal tax, flipping. If you had bought the property as a capital asset and you land up selling it after some time, as an example, and realizing that 100 Rand capital gain, as a natural person, SARS doesn't look at the full 100 Rand. SARS will only look at 40%. So that's called an inclusion rate. An inclusion rate, SARS only includes 40% of the capital gain. So what that means is SARS considers 40, and then you pay tax on that 40. So again, if your marginal tax rate is 45, you only pay 45% of 40 Rand. So your effective capital gains tax as an individual, the highest possible capital gains tax you could pay effectively is 18%. And that is 45% of 40% of the capital gain. As a company, the inclusion rate is 80%. And this, unfortunately, is where people get confused. So a company's tax rate is 27%. Seems very low. And it's a great way to save on tax sometimes by running things through companies. But the problem is that the inclusion is a lot higher. So as a corporate taxpayer, that 100 Rand capital gain, SARS will look at 80 Rand of it and will then calculate 27% of that 80 Rand. And I think it's around 21, 22% effective rate, effective tax. So you'd actually pay slightly more as a corporate taxpayer on capital gains tax than you would as an individual. And unfortunately, trusts are quite expensive if they have to pay the capital gains tax themselves, because it's 80% inclusion and 45% of that. And it's 45% across the board. So I would definitely not suggest allowing a situation like that to happen. But there are ways with trusts to distribute income to beneficiaries. So there are ways around it. But that's basically just the capital gains tax 101 for property investors.
Perfect. Thank you for that.